Welcome everyone. My name's Johannes Rousseau, Executive Chairman of Damstra, and we've just released our FY20 results on the ASX. And thanks for joining today. I think we've got a good turnout, so appreciate the time that you're spending with us, considering this is a busy time of the year. Christian will go through the slide pack, and Christian's our CEO, with our CFO, Chris Scholes. Then we'll open up to Q&A. The way we'll do the Q&A, some people like using chat, which is okay, but we'll also enable people just to ask questions directly of us in an open forum, so people can hear the questions and hear the answers from either myself, Christian, or Chris. And obviously when you do that, you'll need to unmute yourself. So I'll now pass over to Christian to start the presentation. Thank you.
Thank you, Jan, and thank you everyone for taking the time today. I appreciate everyone's busy. We'll get straight into the pack and go through some results for you. So look, good solid year with $27.4 million of revenue, 40% growth versus financial year 20. $34.5 million ARR exit run rate versus $21.2 million at the end of June 2020. 79% gross margin versus 69% in FY20, and 6.6 million in pro forma EBITDA versus 6.8 in FY20. 24% EBITDA margin, slightly down on FY20 from 35, and record cash receipts at $31.7 million versus 20.8 in FY20. 724 clients, up from 279 at June 20, and of course 737,000 users, up on 423. So strong performance, delivering record revenue, cash receipts, client and user numbers through quite a difficult period, as everyone's aware. FY21 saw a continuation of growth across all key metrics, including ARR up 63% there from FY20, increasing cash receipts up to 31.7 million, and of course a large step up there in users in the thousands there from the Vault acquisition. Of course, growth and re-acceleration as we come out of the end of that slowdown through that COVID period. We saw a year of significant achievements across many different areas, but in particular growth. We ended the year, as I said before, 724 clients, an increase of 157. Global user numbers now stand at 737,000, an annual increase of 74%. 34.5 million ARR, 87% recurring revenue, and our products are now used in greater than 20 countries. So really making some progress on that international expansion plan. We passed 90,000 users in the construction industry off the back of the strong performance in that sector, and major contracts with Skanska in those final stages. NBN re-signed for a new 5-year agreement, taking us further across their network, and Newmont is on that signature table at the moment for final review for another 3 years. We're doing a major trial at the moment with a major global mining client, and that's going extremely well. And we're hoping we can start talking contract terms and things like that within the next couple of months. So moving really well there. Products and technology, our EPP continues to be our strategic pivot. A lot of positive feedback on EPP, our enterprise protection platform, reflecting the breadth, the depth, and the integrated nature of our expanded product offering. Momentum, we've increased our R&D expenditure by 34% in total compared to FY20, continuing to invest in those different areas, including, of course, predictive analytics, which I'll cover a little bit later. Paperless form users now exceed 15,000, reflecting rapid growth across that platform. Numerous new products launched throughout the year, including the Damstra safety system, satellite integration, paperless forms, and of course, Solo with an increased range of wearable devices and continuing to expand. On the board level, we appointed this year Sarah Lamala as a non-executive director. She had previously held technology roles with Twitter, Google, and is presently a non-executive director of Whisper. She brings a lot of knowledge to the board, and it was great to have that dynamic throughout the year. North American Advisory Board established. The participants bring a strong background in both technology, mining, and energy, and we've really enjoyed hearing from them and having them review some of our strategic focuses across the the US in particular. Debt refinanced, of course, we secured that $20 million debt facility with PFG. That's all been sorted now. And of course, our increasing North American presence, continuing to invest there. Regional FTE is planned to exceed 30 in FY22, and we're well on the way to achieve that with over 8 in that region now. Record Q4 cash receipts of 10 mil and 32 million for the financial year. Gross margin of 79%, and of course, EBITDA at 24. Operating cash, positive operating cash flow with an emerging path to free cash flow break even in FY22. Certainly a target that we're pushing for there. The Volt acquisition was completed in October 21. Its technology is now fully integrated. We achieved those 6.2 million in annual synergies versus that 4 million target. And of course, we'll see the full benefit of those on an annual run rate throughout FY22. We now have more than 40 global partners and increased external recognition. This includes AWS partner status, Vedantic's recognition, US Security Executive Council accreditation, and inclusion in the Oracle Innovation Hub have all been major achievements for us throughout the last 12-month period. Stepping down, of course, we talk about our enterprise protection platform. It really is the future of Damstra technology. We're getting a lot of positive feedback and a lot of customers using the EPP platform. It's helping protect organizations from unnecessary and unforeseen business risk, focusing on human resources, workplace safety, asset investments, and information. We, of course, enabled through Damstra's resource orchestration solutions. We're able to qualify, monitor, improve, and fuse all the different systems that companies use to make it that one integrated platform, ensuring they've got those prepared people, those safe workplaces, those connected assets, and of course, accessible information, always trying to achieve that goal of a zero harm environment. It really does reflect the increased breadth and depth of our product and our integrations, driving a step change in reducing risk. It's certainly right at the core of our business principles. Of course, throughout the year, we have created more deep integrations of all of our EPP products, as well as added new features. Of course, our temperature detection, our extended solar wearable range, our solar satellite, our predictive analytics are all those significant new launches, along with integrations with our digital forms, Damstra Safety and Damstra Solo, to really close that group and really make it that one fully integrated platform that we keep striving to achieve for our customers. Intelligent workflows are certainly the future of EPP. We've never actually monetized our data, and we believe we have a lot of value in our data, and putting our intelligent workflows and predictive analytics on top of that is helping us to really achieve those goals. We have robust workflow engine-driven natural flows and efficiencies between the different organizational layers to ensure the protection of the organization. We have AI deployed at inflection points between organizational layers for increased efficiency and effectiveness. And of course, the predictive safety analytics uncovering high-risk areas within the operating environment to take action to prevent accidents and incidents before they happen. So there really is a lot of work happening behind the scenes there to achieve that safe work environment. A predictive analytics, bit of a case study here, and I know it looks on the right there that we've just scribbled there with crayons, but it actually tells a really exciting story. By running this against clients' data, we were able to show, using artificial intelligence and machine learning and data analytics, that they had a culture of non-compliance and they weren't really doing root cause analysis. And the regular interactions between workers and vehicles in motion was a major issue for their site. And ultimately, the training that they were providing their workforce was not solving these incidents. And that was by running it through the predictive analytics cycle. There's some explanations there on that chart on the right-hand side, but effectively what it's doing is using machine learning and natural language processing to look for all those links that could differentiate where these incidents are occurring. And really, those dense fusions there are showing highly similar incidents and where the training's happening and not happening. It's a really interesting part of the predictive analytics cycle that we're in. We've invested in our own predictive analytics scientists within our organization, and we're looking at bringing this more to the forefront of our product in the coming periods. drive safety programs, hazard detection, audit, all those types of things in real time is where we're trying to take that process. Bit more on the business update. We talked about 20 countries, circa 20 countries, 724 clients, 737,000 registered licenses, greater than 90 R&D staff, roughly 200 employees in 12 offices around the world. So that footprint is continuing to grow, and we really are a global provider of enterprise protection solutions. Our growth strategy, of course, still remains geography, vertical, and product and channels. Of course, in geography, North America, UK, and users across those areas, we have a lot of opportunity in those regions. We're seeing our pipelines be the strongest they've been in a long time. And a lot of demonstrations, trials, and presentations are underway as we speak. So we're really pleased with how they're proceeding, particularly off the back of those COVID slowdowns last year. And of course, the vertical, healthcare and aged care is an area that we're getting a lot more interest in. We're getting a lot of requests to talk with them and engage with them. And we're going to continue to push that as we scale up in those verticals. We're trying to increase the product uptake in our smaller clients. So the clients that we've brought on over the years through our e-learning platform or our paperless forms, and we're seeing how we can generate more value from those clients. And of course, our channel partners are still strategically important to us on a global scale. When it comes to product and channels, we'll of course continue our EPP rollout being the heart of everything we do, but workflows and data analytics are really the focus of the current period, because we believe that data, workflows, make it seamless, make it smoother, and of course bring that data to the forefront of everyone's mind without them having to really do too much to think about it. It's going to tell them when things may or may not occur, and that's really what our target is, to help keep people safe. Client growth is still coming from an increasingly diverse range of industries. We saw a large shoot up in construction, of course, off the back of the construction demand around the world. And that graph certainly speaks for itself there from financial year 20 to 21. Our channel partners still have multiple channel partners, and routes to market have been established. Of course, channels, we have our referral agents, our advisory board members, business analyst community, structured partner relationships, resellers, solution partners, verticals in industries such as healthcare and aged care. But of course, our international partners that we're still working with, Frostbite, SCC, Vedantic, Zavara, Mission First Consulting, and of course, some of our new ones, AWS, as a partner with them, and working very closely with them on our predictive analytics and how that can help move them through the resource sector and areas like that. So working very closely with our partners on a global scale. I'll just step down now and ask Chris Goss, our CFO, to step in and take you through some more details on the financials. And after that, we'll open up for some questions. Over to yourself, please, Chris.
Thanks, Christian. Good morning, everybody. Thank you for joining us. We have done a quick a summarized P&L on the slide here. You will notice, I think, repeating a lot of what Christian's already mentioned. We have shown revenue growth in a challenging year, which we're really pleased on. And I think the more important story is the assumption of Volt and its run rate when we acquired them, and being able to maintain the revenue and reduce the costs and make it a cash generative business. I think that was a big focus of the year. In terms of, we'll talk a little bit more about it on further slides. R&D as a percentage, this is the OPEX portion of R&D, as a percentage has gone down a little bit. Sales and marketing, G&A costs staying steady. Again, we talk about it a little bit later, but what you, it indicates that operating leverage that we are able to achieve as our revenue grows. I think on the next slide, thanks, Christian, just a little bit more detail. The growth in revenue, the 40% growth in revenue, we have split that out in the next slide, actually, around where that comes from. Again, I think the highlight is a tough year and still managed to grow, but still managed to grow reasonably well, actually. The key message on this slide as well that I just want to highlight, I'm not going to go through every single number, maintaining EBITDA, like we mentioned, despite all that challenges and the acquisition of Volt. But then down at the bottom, we're still making a positive impact. So once we strip out the amortization related to acquisitions, we still have a really good, we still have a positive impact. On the next slide, we actually do, as promised, unpack a little bit of our growth. It's a really quick illustrative graph, but I think the key highlight on this is our focus that we've put in the last few years on the construction industry has really paid off this year. As we're all aware, construction was up until recently very much unaffected by COVID. Plus, there was pretty big investment from federal and local governments and state governments into the construction industry. So we're very happy with our performance in construction. That was also reflected in our user numbers as well. So construction was a good play. Show the acquired revenue. And then the other key message, of course, is, as we called out in previous slide packs and previous presentations, the little grey box on the side there, we had those two headwinds with two really specific clients. These are not surprises to anybody. Had that not happened, our revenue growth would have been even more. Now, this was part of what Christian will talk about in a second, but as those things normalize going into the future, we do expect to see that revenue coming back and increasing again. So we illustrate on the next slide, we illustrate that operating leverage I was talking about. Again, this is for those of you that have seen our presentations before, you're aware that we do this. As our revenue expands, we do show increasing percentages. Our cost base is relatively fixed. It's about 2/3 fixed versus a third variable. So as a percentage of OPEX, as we grow, as our revenue grows, our percentages grow. So that theme is not changing. And in fact, even in this year, like I said, even in this year with all the challenges we had, that theme still maintained true. So it does show that the underlying business is very healthy. Just going to run a little bit through. I realized there was a question about it as well, so I'll just answer that very quickly. R&D spend, it's, as we mentioned earlier, we are still investing a lot into the enterprise protection platform. That is the future of this industry. So we're still investing in that. Predictive analytics is was another big theme for the year, and of course integration. That's where we were for this year. I do expect the costs to stabilize, more or less. But I think the key thing is we are still investing into R&D. Now, just a quick little explanation. The 6.4 on this expensed chart is a combination of what's already in cost of sales plus the OPEX expense. So that's just the reconciliation to the previous slide to answer that question. So profit performance left aside, of course, the other thing that we really focus on as a management team is operating cash flow. Record receipts, nearly 32 million. Never had that was a really fantastic year. We illustrate the effect of the financing activities that we did versus the investment into assets. So I think the key point from this slide again is going in a challenging year, we did well. Going forward, as these synergies become embedded into the business, number one, and number two, as our revenue grows, we can see the pathway towards a positive or free cash flow. We do a quick little illustration on the next page around that, but of course you can have up months and down months, but this was very definitely a trend towards that positive free cash flow, which is as I say, a combination of increased leverage and revenue growth. I think there's just a quick little recon on the next page. I don't really plan to focus too much on it. We do call out the difference between the statutory and the pro forma EBITDA. This is also repeated in the actual financial statements. So I think that's it. Thank you very much, Christian.
Thank you, Chris, and well, thank you everyone for listening to the presentation. And Jan, we might open up to questions.
Yeah, we've got some questions. I mean, the Q&A system is also working, and I see Cam, who I know well, has asked some questions. Cam, I'll ask Chris to answer the first part, but on EBITDA margins, I mean, you see our guidance there, which, I mean, you could say is essentially flat. What we have in our plan, as you see, we've got about 200 staff, and then this year we're going to accelerate investment in staff. I think we're going to put on 60 new staff, and you always have some churn in your organisation. So those staff are not so much about delivering this year's plan, or part of them are, but the majority of it is like building out the US and other locations in terms of more BD and some development staff. So if we wanted to, the question some people have asked me, if you ran the business for cash and you didn't put any more staff for FY23 and 24, yes, our EBITDA margin would obviously expand. And I think the analysis that we did internally was, if we ran for cash, yes, it would go to the high 20s. So the leverage is there. So it's a conscious decision. I know Wilson's have looked at that. The leverage is there, and we're just investing in terms of future growth in FY23 and 24. So Chris, do you want to answer the top question in terms of the guidance?
Yes, Kevin. In terms of that growth, that is a good pickup. There is a split between new wins and growth from existing clients. It's about 60-40, give or take. Get towards new client wins, with 40% coming from expansion into existing clients, especially construction, where we see a lot more happening, and cross sells as we integrate and bring all of our modules together.
Thanks, Chris. Christian, got another question here regarding the mining client. Maybe you could even talk about the trial. It's just not a conversation.
Yeah, no, absolutely, Jan. We've actually been doing a lot of work with this particular customer. They've got operations in +6 countries around the world, circa 30 to 40,000 people. So it is quite a large opportunity here, which is fantastic. We've actually been doing a live trial with them. They've actually been trialing our Damstra Learn system. They've been trialing our Damstra Form system. And we've actually done some pretty amazing workflow work with them to automate some statutory forms that take a lot of their time on an annual basis. That's all gone extremely well. Those trials have been happening now for the last couple of months, with the trials actually coming to an end this month, with a plan to start talking contracts throughout the month of September. All going well. The next update on that customer, I would predict, will be during the month of October.
Thanks, Christian. Christian, an extension. Happy to take more questions. I mean, I think we've got some 60 attendees on, so if anyone's got any questions. Christian, you want to talk about Australia is obviously different at the moment. We have in Australia, flagged, obviously, a lot of us are in lockdown, a lot of us are at home right now. We do have construction clients, and we have seen a bit of an impact with what's happening in New South Wales and Victoria. And we all see that, albeit most construction is still running, but at reduced capacity. But we did see that last year when we went through COVID, when lockdowns opened, it quickly re-accelerated back. So in our guidance going forward, we have incorporated the impact of New South Wales and Victoria, basically, like all of us, hopefully we get out of lockdown, before the end of the year. Kristen, did you want to talk about what's happening in the US?
Yeah, absolutely, Jan. So obviously, it's not just that mining client. We're about to put ink on the paper for that Newmont extension, which is fantastic, for another 3 years. We've also got a much stronger pipeline there than we've ever had before. What we've found is when they came out of really they've gone into what they call COVID normal there now. Even though they're having a couple of 100,000 cases a day, they're still operating fully open and running as normal. And what we're actually seeing there is we've now got 3 other gold mining companies that we're actually in stage 2 discussions with and talking about entering trials. We've got a diamond mining company who operates in 3 countries in early stages of discussions. We've got a couple of construction organisations. We've got a healthcare company, but they're all very, very large, good opportunities and really progressing well through the process. So that coupled with our further investment in the US, of course, with more sales, more support, and really getting some technical resources on the ground there, we are feeling really comfortable about where the US is going to take us over the coming quarters. So a lot of activity there, very positive.
Christian, Claude Walker, and Claude, we haven't spoken, but know of you and know you speak to CFO Chris a bit, but Claude's asked a question about EPP, and that actually links into how we're penetrating the North America. Christian, you want to talk about unpacking EPP for people that aren't aware of why and how we're positioning it?
Absolutely, and Claude, good to speak to you again. I have spoken to Claude a little while back, and yeah, the EPP, so the Enterprise Protection Platform. So we've always had a platform, Claude, but as we started to acquire other parts of our system, such as the paperless forms, of course, Damstra Solo, Damstra Safety, and all of those types of systems, we packaged it all together as one fully integrated enterprise protection platform end to end. So not only can a customer pick it up and take care of all of their people, their assets, their safety, their forms, their access control through the one platform, but in particular, we have an orchestration layer. And that allows us to go into customers who already have parts of our platform somewhere else, because as we've said many, many times, there's a lot of single point solutions out there. And there might be a customer using another e-learning system or another access control system. And what we've done is set up our enterprise protection platform to be able to orchestrate with that existing product through our open API system so that they don't have to rip and replace everything. We can actually sit over the top of it and give them a seamless experience across the entire enterprise protection platform. And of course, EPP is partly messaging. It's really lining it up with the ERPs and the CRMs and those types of platforms that already exist in the corporate world. And it's been received extremely well, particularly throughout the American marketplace. So we're continuing to drive that, build that out, and make it your one-stop shop and one entry point for every single thing to do with keeping your workplace safe.
I see we've got a question from Vince regarding cash on bank. I'll ask Chris to answer the specifics on that, but just a strategic positioning, Vince, and the other shareholders. I mean, people saw that we took out a facility with PFG, who are well known, especially in the tech sector. What we wanted to signal to the markets that we had some capacity, one, to borrow, which was good because we've got the flexibility and people have done due diligence on us and prepared to loan us funds. But two, we wanted to make sure to the markets that you got the view that we weren't going to hit you up for a capital raise to run an operating business. A lot of the investors here do invest in tech stocks, and there's always that balance of pursuing aggressive growth, but not burning cash in your back pocket, as we all know, using very simple language. And so you'll see the PFG facility was to give us that flexibility where we can have some comfort and do what we want to do. Also, you could see people look at operating cash in the quarterly reviews, but they go to the next line. You know, what are you capitalising in terms of R&D and what's your free cash flow? So we spent a lot of time looking at that, and I think what gave us comfort during the last quarter of last year, after we, acquired Volt, really worked hard on those synergies, and we saw those savings come through. And I'll be quite honest, that was a risk that the board took in terms of acquiring a loss-making business, but we were able to deliver that we saw free cash flow starting to pop up in the last couple of months. So that just gives us comfort that we could go forward, still grow, invest in those additional 60 people, invest at the R&D level that we're presently investing, achieve our guidance and not come to the markets for operating cash in terms of the rights issue. It's just been very upfront on that. Chris, do you want to talk specifically to Vince's question on the 6 mil?
Yeah, absolutely. So just to clarify, Vince, we've got cash in the bank of nearly 10 million at the end of the year. We borrowed, if you wish, 6 million throughout the year. Those are, you might recall back that we used to have a leasing facility with our bank where we were able to finance assets as we bought them. So the financing that we've put in place with Partners for Growth effectively just replaced that facility. So yeah, it is. So, yeah, indeed, there is 6 million from borrowings, but it was all invested into expansion and assets rather than operating expenses. I hope that answers your question.
Someone's asked a question on dividends. I suppose it's always a view of what's your free cash flow and is the ability to do it, and then versus the investment you want to make in the business to accelerate the top line. So our board, as all boards do, discuss dividends. I mean, our view at this stage is we have no intention. We don't have any intention in the short term to pay dividends. But having said that, there are a couple of tech companies, larger companies, which are generating free cash flow where small dividends are paid, and that's something we'll obviously reassess in the coming years, but not in the short term. Got a question from Ross regarding synergies. Yeah, Ross, there are, I mean, for people to know, when we did the acquisition, we actually, and that's a number over my head, there were 132 different action items in terms of integration. And we had, I think, in excess of 40 duplicate processes or systems that were retired. And that's got us to the 6.2. And that could be things like, AWS, payroll systems, a litany of IT subscriptions, duplicate software packages, etc. And the list goes on. There is a bit of scope more. I think there might be another $500,000 there, and I think that's about it. We're really focusing on growth now. Got no more questions. I'll leave it. Happy to keep on taking. We scheduled an hour for the meeting, so if people want to ask more questions, very happy to take them.
Yeah, and it looks like Ross has just put another one in there regarding the Vault acquisition.
Yeah, I mean, we are happy with Vault. One, because of what it's done from a product perspective, which makes us deeper, and also makes us filling out what we call our EPP platform. It really makes this platform very robust. Also, the integration from a technical perspective has been done, which was a real achievement for us, and I think something we are proud of. People always look at, why can't you grow faster? But to acquire something, achieve those synergies and technically integrate is a really hard thing for companies to do, and that's something we pride ourselves on. M&A, I'll be quite honest, Ross. We review hundreds of companies around the world, and that's not just to acquire, but we look at what they do from a product perspective and a client perspective. There is, for people who follow our sector, and we could say we're in the workforce management or the fringes of HCM, or even in the US now. You've recently listed a company called Procure, who's in the construction space. If you look at all those spaces, there is a lot of I would call M&A activity, especially in M&A, especially in North America and Europe. There are people trying to do consolidation plays internationally, and we are looking at opportunities. There are opportunities in North America, also South America, and actually there's some opportunities in Australia. I think from a board perspective, if we did something in Australia, it would have to be more opportunistic and at a good price. But I think our focus would be more the Americas to build on the success we have there to accelerate growth. The shore plan, Marianus, yeah, we have disclosed the shore plan, and we've done that for a reason. So I'll let Christian talk about shore plan.
Yeah, thanks, Jan. Look, shore plan is a contract that we obviously inherited from the Vault acquisition. It was a take and pay contract effectively, where we gave up some rights to an area in New Zealand, and they were outselling and marketing the Solo Drive product. And they were a partner in that, and they had minimum volumes in that contract, and based on legal advice, we invoiced them as per that contract and those minimum volumes. They're disputing that they actually have minimum volumes, even though the contract is very, very clear. And therefore, we did not recognise that $1.6 million of revenue in our financials. If we had we of course would have exceeded the $28.1 million target that we had there. So unfortunately, we weren't able to recognise that, and we will be looking at our legal options going forward to recover those funds. Now, that is a 5-year contract. It is the only one of its kind. Damstra does not typically enter into those types of contracts. It was inherited from Bolt, as I said, and we are confident that we have a strong case there to get that money back, plus the remaining years of the contract as well, given it was a 5-year fixed term contract with minimum volumes. So we'll be taking that to the full extent that we can.
Yeah, and just add those comments, Marianus. I hope I pronounced your name correctly, but I had a view and so did the board that we like to disclose to the markets what we're doing in an open sense. We technically didn't have to disclose that, but I think the reasons that we did was, one, if that contract, was fulfilled as legally Short Plan were required to do, we would have had an incredibly strong year last year, and we were able to deliver the results we were able to deliver with that. Then that goes back to the question of how you've acquired the business and how did this happen, and I think that's something we reflect on. And we did our DD on that contract. We had supporting data that was take or pay, and to this day we still believe it is. I think the other issue for us is when a business gives up exclusivity for a sector to enter into a counterparty contract with someone else, everyone knows that's a significant value, and that's what we've done. So as required, we'll keep the markets posted on that. We have not planned for Short Plan revenue in our forecast, and the market should be comfortable about that. But Christian and I and our board tend to say we'd rather keep the markets fully informed rather than someone picking something up on the wires and asking us a question. Peter, yeah, it's a good question. Chris, you want to talk about that? That's something we spend an inordinate amount of time on in customer contracts, IP assignment clauses, etc., and our risk management framework.
That's a great question, Peter. Yeah, we do that, as Jan said, we spend a huge amount of time on it. So I'll just go through a few of the basic things. In terms of contracts, yes, we do have IP protection in all of our supplier and employment contracts, including assignment of moral rights, etc. So we do deal with that. Then in terms of the risk management framework, cybersecurity, etc., you would have seen on our website that we are both accredited for ISO 9001 and ISO 27001. As you would probably appreciate, there's quite a number of processes that go along with that before you can get that certification, a formal risk management process. Even silly things like, which you might think is silly, but it's really important to security, regular engagement with employees, etc. Then the other accreditation that we do have, which a very few Australian companies do, is a SOC 2 accreditation. So that's an audit accreditation from the American Institute of Chartered Accountants, or CPO, where they again specifically look at your risk management and your procedural frameworks around that. So we invest a huge amount of time and money into that. We have a full-time global data protection officer, so who would, amongst others, in between dealing with these accreditations, we deal with all our privacy issues. We do have an internal audit framework, and we do regular hardening and checking of our cybersecurity framework. So actually, that's one of the things that we are actually quite proud of what we've achieved over especially the last 5 years.
Yeah, Chris, I might jump in there as well if I can, because we all know how important cybersecurity is to our organisation. I mean, it's right up there as our, one of our number one risks and one of our number one focuses. And we work with some large organisations around the world, and one of the largest mining companies that we deal with in the world recently conducted audits across their entire supplier network. And we were the only company who does work for them in their entire supplier network who had zero defects in their cybersecurity and network security processes. And on top of that, we mentioned that large global mining company that we're just doing a trial with at the moment, and we're going really well. One of the first things we had to do before they would even let us do the trial was go through their cybersecurity team. And once again, we were able to provide all of our information in a pack, and we had zero qualifications or questions about our pack. They came back and said it was amazing to see that we were so organized. So it is a sector that we spend a lot of time on, and we're actually really proud about what we do. One thing you won't see us do much of, and this is on purpose, is we don't get out there and promote it on websites and things like that. We talk about it behind closed doors. And the reason for that is because people who do go out there and beat their chest on their public website really do put a target on their back for those 15-year-old hackers out there who have got nothing better to do than try and prove a point. So we purposely don't go out there and say we're the best, but we certainly have the best processes, and we're happy to share that with our customers day in, day out.
I'll just give someone a question to ask. Any final questions? Oh, Peter's asked an interesting question. It's the type of question that we reflect on all the time, Peter, but I'll let you answer that, Christian. Where do you think we've underperformed in FY21, and what are we doing in terms of a response?
Yeah, it's a really good question, Peter. Thanks for raising it. I think it is one that we reflect on a lot. Where could we have done better? And I think one of the key areas that come there is our pipeline of growth. We came into the last financial year and we didn't really understand what COVID meant for us and where that was going to go. It wasn't one of those things that you planned for. But what's come out of that is we needed a bigger pipeline, more advanced, faster than what we had. So we've put a lot of effort into growing that pipeline in all regions around the world. We've added those different pipeline levels to people's KPIs. We've given them a different level of training around getting those pipelines. We've actually changed some of our direct sales approaches and implemented BDRs to set up phone calls and meetings and really drive that growth. And that's performing extremely well. But I think that is one area that we could have performed better in to really get that top line revenue. But ultimately, those slowdowns around the world throughout COVID was an area that we didn't really understand until it occurred. But that's an area we definitely could have done better in.
Since we've got no other questions, Christian, do you want to make any closing comments?
Yeah, thanks, Jan. I think once again, thank you everyone for listening today. We really appreciate it. Look, we've come through an uncharted year, if you like, off the back of COVID and through COVID, and certainly it's not the end of it, but I think that we are really well positioned to achieve the targets that we've set. We're setting our team up for success. We're growing those pipelines. We've changed those processes. We're also investing very heavily at the moment throughout our entire organisation in leadership training, in education, in retaining staff, and making sure we've got the right talent doing the right jobs, because we all know having the right people is the first step. So once again, I think we're in a good position, heading in the right direction, and the next 12 months will tell another great story. So thank you for supporting us.
Thanks, everyone. We'll close off the session today, and thanks for your participation in our results for FY21. Bye, everyone.